Welcome to the special presentation of the week, this week titled The Inside Story on This Bull Market. My name is Todd Shaffer, Manager of Research for VectorVest, and I'll be your presenter this evening. VectorVest believes that stock value increases with rising earnings, falling inflation, and falling interest rates. In a post-financial collapse world, we still believe this to be true, even though the landscape has become more confusing. We operate in a world of record public and private debt, quantitative easing, fractional interest rates, even negative interest rates, slow GDP growth, etc. VectorVest has helped us navigate these markets with a fact-based analytical model that points us toward the truth of what's really going on in the economy and stock markets. It's all displayed in the truth chart, as Dr. DeLito's been writing about with some frequency lately, in particular on March 17th. Let's go to the views. Here we are inside the program on the Views tab, looking at our essay from March 17th, 2017, titled The Case for Bull Market Scenario. In this essay, Dr. DeLito once again describes how the system works, how we define bull and bear markets. But if you recall, bull and bear trends are defined by the trend of earnings. When earnings are trending upward, we're in a bull market. When earnings are trending downward, we're in a bear market scenario. The trend indicator is on a 0 to 2 scale, so values above 1 indicate earnings are trending upward. Values below 1 indicate earnings are trending downward. As we reported in the views last week, the earnings trend indicator closed lower at 1.00. This week, it may go lower. If it crosses below 1, the market scenario will change to a version of bearish. But as Dr. DeLito wrote here in his essay, there's nothing to worry about if the EPS trend indicator goes below 1. It will not stay there long. The primary reason for the dip in the S&P 500 earnings per share graph is the poor performance of the petroleum companies. The earnings performance of other companies remains very good. You can see all these effects by viewing the EPS graphs of the S&P 500 All-Petro and S&P 500 Non-Petro watch lists. Now, we've demonstrated the click-by-clicks of how to view the watch lists and set up the graphs in our previous video demonstrations, so I want to shortcut that part of the presentation tonight. But I wanted to address the question, how does Dr. DeLito know not to worry about the EPS trend indicator going below because it won't stay there long? Well, how does he know? Well, it helps to have designed the indicators and studied them over the last 20 years, I suppose. In particular, his understanding of what goes into the top line number and how it has performed in the past. But he gave us a clue. The primary reason for the dip in the S&P 500 earnings per share graph is the poor performance of the petroleum companies. The earnings performance of the other companies remains very good. You can see these effects by viewing the EPS graphs of the S&P 500 All-Petro and the S&P 500 No-Petro watch lists. So let's first take a look at those watch lists from which we derive our graphs. We'll come down to the watch list group and let's scroll down to the S&P watch lists. And here we see there's an S&P 500 watch list, which is the entire S&P 500 index. Then we have a watch list for the S&P 500 petroleum stocks and the S&P 500 without the petroleum stocks. We begin with the S&P 500 group. Here are the S&P 500 stocks, and here is the average of all the stocks in the watch list, from which we're going to derive the average earnings per share information. In the S&P 500 All-Petro, we notice that these are all the stocks that are in the petroleum sector. The S&P 500 No-Petroleum is all of the S&P 500 stocks with the petroleum stocks removed. So those are the building blocks. Let's move over to the Graphs tab. On our Graph tab, we'll begin with the Market Climate graph. On this graph, we have on our top graph the S&P 500 earnings, as taken from our S&P 500 watch list average line. On the bottom graph, the subgraph, is the trend analysis of the S&P 500 earnings movement on that 0 to 2 scale, and we see that we're currently at the level of 1. Our next graph is the graph of the S&P 500 watch list. On the top graph is the price action of the average price of the S&P 500. On the bottom graph is the earnings per share information again. This is the raw data in the blue line. The orange line is a 50-day moving average of that EPS information, and that's the line that's plotted on the climate graph here. The next graph is the S&P 500 All Petro, which includes only the petroleum-based companies. And notice I have a very different graph shape. Again, the average price of the petroleum companies, but I can see that they really peaked back here in June of 2014, as did their earnings shortly thereafter, and they've really been trending downward quite strongly over this time frame. Our third graph, the S&P 500 No Petro, we notice once we take the petroleum stocks out, still have a nice elevated price action as well as nice elevated earnings, stair-stepping higher and higher. So starting with the climate graph, looking at this graph, we notice that the ETI, the earnings trend indicator, our purple line, has gone below 1 on 2 previous occasions, and of course maybe going below 1 currently. This line of 1 then is a demarcation between bull market and bear market. So the question currently at hand is, well, we're down at the level of 1 again. Should we be worried about crossing into the bear market? Dr. Dolito says not to worry, but let's apply what we've learned from the VectorVest views. The first bearish crossover here, if we put a date line on it, was March 27th, 2015. Let's find Dr. Dolito's advice in the views from that date. Going back to the views, let's change our date back to 3/27 of 15. Here is his essay titled, "Fear Not This Bear Market Scenario." We'll pick him up in the third paragraph where he says, "As I have stated in my recent earnings update essays, there's no need to panic over this bear market signal. Earnings are still robust, although they are being pressured by the strong dollar and lower oil prices." Kind of sounds like today, but he continues, "Moreover, inflation and interest rates are still at historic lows." Let's go take a look at our graphs again in this time frame and see if we can derive some clues why Dr. Dolito again wasn't worried about this bear market scenario. In this time frame, we know that the earnings per share average has been pulling back on the S&P 500 broadly, and our trend indicator had just crossed below 1. If we look at the S&P 500 graph, I've now adjusted the hard right edge to be on that same date of March 27th, 2015. Here we see the price action of the S&P 500 is still rising, while the average earnings have indeed been pulling back, but they have now started coming back up off of their low, curling back higher, converging with that 50-day moving average. So the good news here is that the earnings per share on average are starting to rise again, but they're not getting much help from our All Petro group. So here we see the price action for the All Petro group of S&P 500 stocks has pulled back sharply, now kind of basing here, slightly moving higher, but with a lot of volatility, and we see the average earnings per share is just tanking. And yet if we look at the S&P 500 without the petroleum stocks, we see that same upward price action. Earnings again had pulled back, but they're now starting to rise again. And so the takeaway here is that the downward movement, the downward pressure on the S&P 500 earnings is in large part driven by the petroleum sector. So with the majority of the sectors still performing well, and the overall group recovering in their earnings, we could project that those lines were likely to cross in the near future, and once earnings were above the 50-day moving average, we would be able to curl the moving average, the trend indicator, back higher. Of course, that's exactly what happened when we go back to the climate graph. We see the moving average curling upward and the trend indicator turning back above 1. Our next crossover happened here on February 12th when our trend indicator went back below 1. Let's see what Dr. DeLito said about this crossover. Here we are in the views on February 12th, 2016, the date of our crossover, and the essay was titled A Bear Market Scenario to Fear. Unlike the bear market scenario which was signaled on March 27th, 2015, this signal is shrouded in ominous circumstances. Last March, I said the bear market scenario should not be feared for several reasons. Earnings were still robust, although they were being pressured by a strong dollar and lower oil prices. So what was different this time? Well, Janet Yellen, head of the Fed, did raise interest rates on December 16th of 2015. But let's take a look at our graphs and see if we can get some additional insight. So here we now are on our second pullback. Again, the 50-day moving average of earnings is falling, but the trend indicator now has crossed back from bull back into bear territory. When we look at the S&P 500 graph, we notice price action is in retreat, and we also see that the earnings data is in downtrend, as is, of course, the moving average. When we look at the petroleum stocks, they're continuing in their downtrend and also have gone noticeably from average gain to average loss now as the price action continues to move lower. And when we remove our petroleum friends, we notice that the earnings performance is still dropping off for our non-petroleum stocks as well. And so with all three graphs in downtrend, we are seeing a much broader based retreat in the earnings performance of the S&P 500 group. And indeed, as we look back at the market climate graph, that downtrend much deeper than the previous downturn in the market. And so that brings us to the current marketplace, where we see that the ETI just closing at 1.0. In his market climate remarks from 310, in anticipation of this crossover, Dr. D wrote this. We'll join him in about the 12th paragraph near the end of his remarks. Let's see. It appears that the two lines are converging at the rate of about 1 cent per day. Since they're 6 cents apart as of yesterday's close, they should be crossing by next Friday. Once the earnings per share line goes above the 50-day moving average line, the 50-day moving average line will slowly start heading north again. All we need to do now is to check this graph once a week and see what happens. I'm not going to pay any attention to the perma-bears who are predicting ridiculous bear market crashes because it appears to me that the earnings will be heading higher soon. To be sure, I'll stay the course and keep checking my investment climate updates. Let's go back to our graphs one last time to check the trends in this current market. Again, we see that earnings are pulling back. We see the trend indicator right at the level of 1. On the S&P 500, we see the earnings have already made their turn and have crossed above the moving average. If we check our friends in the petroleum sector, their earnings too are on the uptick, although they are starting to curl over and slow down. They are still rising. And our non-petro friends also have made that turn, and their earnings are on the uptick. So broadly speaking, this scenario much closer to our first scenario where earnings were able to rise again and just have a temporary crossover of the earnings trend indicator than we were in the second instance. So obviously it's important for us to know whether or not we're in a bull or a bear market scenario, but what action are we supposed to take? What are we actually supposed to do with this information? Well, again, let's turn to the views. And here I'm taking an excerpt from the views from August 12, 2016, titled The Bull Market Scenario Has Returned, and we'll pick it up in the second paragraph. One should be aware that these market climate signals are strategic and not tactical. This means that our expectation is that stock prices will continue to rise as long as earnings continue to rise. This expectation does not prevail over our market timing system. Do not ignore our market timing signals, and do not listen to people like Mr. Mark Faber, aka Dr. Doom, who just predicted that the S&P 500 will crash by 50%. Stay tuned for next week's earnings update and rejoice that the bull market scenario has returned. And what a great sentiment on which to close our presentation. I thank you for being with me. Please join us in the future for all of our special presentations. Should you have any questions, please give our folks in product support a call. And otherwise, have a great evening. Bye-bye.